What's the intro? I mean, we're doing a podcast. This is our first one. I'm a local real estate agent. I service Port Stanley, St. Thomas, and London. And as anybody out there knows, this is probably the fastest growing real estate market in Ontario, which Ontario, by and large, has accelerated most other provinces. So I'm here to talk to a good friend of mine, Nathaniel Freeman. He is a real approved mortgage agent. And he's basically the bread and butter of the industry. He's going to get you the money. Some of my clients call him the money man. So not just a trade name, but he is a guy who consistently gets my clients extremely low rates and, gets the deal done on time. So I think that's what's most important to most people. So, hey, Nathaniel, welcome. And how are you finding business these days?
Man, first of all, thank you for having me here. I appreciate being on the podcast. I know this is our first one, and I'm sure we'll do many more. But yeah, it's great to be on. Business nowadays is good. We're seeing an increase in housing costs. Of course, you can attest to that. But with that, we're seeing an increase in mortgages, which means getting your client the lowest rate is an important factor. But that being said, a lot of people see mortgage rates as the most important part. What I don't consider the rate to be the most important part when it comes to getting a mortgage. What I find the most important part is the monthly payment. Because if you can't make your payments, it doesn't matter how low your interest rate is. So the main factor that we look towards is how much cash flow are you going to have. For example, this is some people, they want to go with 25 years and get the lowest rate possible. But with that, getting the lowest rate possible, you usually have a higher interest payment compared to if you took a little bit higher of a rate and you got a 30-year amortization.
That's what I did. I mean, in my own personal house, I got a 30-year because that's like my thing. Cash is king. I always want to be able to, leverage my cash flow. So that's how I run my own personal finances. Not that anybody else should do what I do, but that's how I do it too. Like I want to keep my cash free, and you never hope that something bad's going to happen. You never hope that an accident's going to happen or you're going to miss time at work. But it does kind of build in that security that you don't have to worry, like, what am I going to do to make, the payment this month?
Oh, absolutely.
Kind of takes that out of it because you've got yourself at a budget that's heavy cash flow. I think one question I got for you, and everybody asked me, is where are people finding the money? Like, where we got, like, the average house is creeping on $1 million. Where are people getting the money for this? Like,
the majority of people are getting the money from equity. If you have more than 20% down payment, we can get you a mortgage.
So don't tell that to my first-time home buyers.
Well, I know that's hard for first-time home buyers to hear, but the main thing is 20% down. That's where people, and pulling equity out of your current home, that's where majority of people are getting the money to buy their next house. Because once you have 20% down, we don't have to worry about the government saying you have to qualify at 5.25. We don't have to worry about 30-year amortization. We can stretch that amortization out to even 40 years if we need to. I've heard some lenders are introducing 50 years. So when people are buying these massive houses, they're taking on a massive amount of debt.
Which leads to my next question. How healthy, that's what everybody wants to know. Is there a bubble? Is the bubble going to pop? Are we getting way too inflated? People are wondering. I've had clients actually ask me, can we list the house now? Like, can we do it sooner than I even wanted to, just because they're nervous. They want to make sure that their money, that their capital invested is protected. They don't want to lose any of that.
No, absolutely. And it is a huge question a lot of people are asking. From my own experience and from what I can see in the market, I don't see how this is going to take a downturn. I'm not saying we're not in a bubble because I don't have every single piece of information out there imaginable. But what I'm seeing a lot of is somebody buys a house on the street and it goes for $100,000 more than what everybody else thought it was. Every single other house on that street now appraises for $100,000 more, which means those people are refinancing, pulling out their equity without even selling their house. Their house has gone up in value and they can pull out that debt. Now, what they're doing is we've seen 19% of last year's home buyers received a down payment or a gift of down payment. The average gift of down payment in Ontario last year was $170,000.
So 90% are getting the gift of down payment.
No. I apologize. 19%.
Oh, sorry, 19. Okay,
Yeah.
I was gonna say, like, where were my
that
where
would
were
be-
my mom and dad? Where were you? Where were you on this?
That would be massive. But 19%
Okay.
are seeing that. And the average gift is $170,000 in Ontario.
It's pretty hefty.
So parents, they're going out there, they're seeing the massive rise in equity in their house, pulling out that equity, giving it to their kids so they can finally get in the market.
Is that scaled up over the recent years? Because I get, like, in one sense, like, I'm seeing, like, the need for it to scale up in terms of the gift to make things happen. But in the other sense, I'm thinking, like, cultural differences, like, you know, new immigrants to Canada who, you know, whose parents have, you know, those core values a little bit more ingrained in their culture, you know, that this is how we take care of our own people. You know, we're going to take care of my son and daughter. We're going to give them, you know, that opportunity.
Yeah.
Whereas I don't know if, you know, you see that in...
Well, we could definitely say it's scaled up over the years, especially considering the last 10 years. We've seen more people get gifted down payments. I can't say to how much it is. I don't have that statistic in front of me, but I'm willing to bet this $170,000 as a regular average gift given to Canadians. I know I didn't get that much, even close to that much from my family when I was buying my house.
So yeah, how did you do it? Because you were just recently a first-time home buyer.
Yeah.
Right? And you were able to get it done in a pretty hot housing market. So what did you do? Like, what was the sacrifice you had to make? Because I tell my buyers, like, you know, you can't buy the new vehicle. You can't, you know, it's all based on, you know, your debt to income ratios, right? So for people who don't know, why don't you talk about what that is, but talk about what your own personal, like, sacrifice, like, what did you have to do to make it happen?
Well, what I had to do is I had to save up a massive down payment at the same time as paying off as much debt as I possibly could. A lot of people think if you just put down $5,000 on your car, well, your payment is still the same. You got to lower your monthly payment. So you got to pay off the car loan completely. You could have $2,000 left on the car. If you're still making an $800 payment, that's still going to go against your ratios. So you got to pay off that debt completely, and you need to save a down payment. I had to use 10% down to purchase my current house. And the first house I bought, it wasn't the dream house. It wasn't fancy. It is a fixer-upper by the definition of it. You can live in it, but the bathroom was terrible. You've seen it. It's god-awful.
It's bad.
It was
terrible.
Bad. And, like, but that was one of the things I had to sacrifice. Like, I had to deal with, okay, this isn't the house I want. It's the house I can afford. And knowing that...
And you didn't have a car payment either, I think, is a...
Well, I had to pay off my car completely.
Right, okay. So that was like a major...
major bump up in
contributing.
How much I could get.
Right.
But accepting that I could get less of a house and knowing that with real estate, your first house is not your forever house. It's not going to be the nicest house. Your first house is often a stepping stone into a nicer house.
Sure. Yeah, 100% agreed. Yeah. So I guess, like, for people who don't know you as well as I do, and the fact that you don't really eat vegetables and you don't, you know, everybody else who's like a normal Canadian who's getting affected by the grocery bill going up, Nathaniel just eats pizza pops, and I think that's the biggest, might be the biggest
pizza. Not pizza pops.
That's like
I need more substance.
I think the big sacrifice.
Well, it, like, keeping your monthly expenses low, that is huge, because the less your monthly expenses are, the more cash flow you have, the more you save up for that down payment, the more you can attribute to investing.
I went through it myself. Like, I cut, like, when I was young, I cut my data plan. I made sure I wasn't overpaying for my cell phone.
Absolutely.
You know, subscription services, anything that was just kind of like, you know, you assess your needs versus wants. Did I need Netflix? Did I need Prime? Did I need Crave and Disney? Could I deal with just one of them and pay the $13.99 a month rather than having an $80 stacked entertainment bill that really, you know, it's killing my monthly cash flow, which is, you know, in the end, it's going to keep me out of the housing market.
Well, a huge thing people need to do is make up a budget. If you're not making up a budget, you don't know where your money is being spent to. I know family members who are not in the housing market that make more money than I did when I got my house. And they're spending a lot of money on fast food, on Tim Hortons coffee, on subscriptions, on all those little things where it's just like, okay, you may have spent $2 a day, but that $2 over a month is $60. So you're looking for money, run up a budget, And I guarantee you will see that you're spending money in areas you don't want to be spending money.
Yeah, 100%. What kind of like vehicles for saving are like the best for first time home buyers? Like I know like the RSP, like the tax free element. Like how does that work, and how can they like use something like that to get into a house a little bit quicker?
Well, with an RSP, you can say, when you're going to purchase a house, you can pull up a max of $35,000 out of your RSP.
Okay.
Now, as we see house prices growing, the government will probably expand that, because right now it's sitting around between 5 and 10% if you want to buy in the London market, that 35,000. So once you fill up your RSP, because when you fill that up to 35,000 and you pull that money out, that's tax free. You pull out anything above that, you do have to pay taxes on it.
And you do have like is it 15 years still? Because it used to be like back when I was buying my first house, I think it was a $25,000 limit, and they gave us 15 years to pay it back. Like is that still the same?
It's still 15 years.
Okay.
Yeah, it's still 15 years, but after you reach that maximum 35,000 in your RSP, then I would go over to your tax-free savings account, where you can invest it in broad-based index funds or just a high-interest savings account to build up the rest of your down payment. There's no sense in putting $40,000 into your RSPs if you're going to pull it out to buy a house. Now, if you're in a couple and you're buying the house together, you can put both your first-time home buyers plan together, so you can pull out effective $70,000. But if you're an individual, or if you're two individuals looking to buy a house, after you put in 35,000 or you've grown it to 35,000, there's no need to put any additional money in to purchase a house.
Okay. Yeah. What are the rules regarding? Because it's kind of the unicorn. People ask about it, like borrowing the down payment. What's the hard and fast rule about? So, is it possible? Is it legit? Is it a shady practice? Is that something that
it's hit or miss, because once you borrow the down payment, you have to include that debt into your ratios. So during the pandemic, there was a period where the government said you're not allowed to borrow any more down payment to purchase properties. They have since lifted that statute, so now you can borrow money to get a down payment. But once you borrow a nickel, you have to include that into your ratios.
And your debt repayment.
And your debt repayment goes up. And so your ratios go up. So that kind of conversation is something you should have with the mortgage agent, where we can look at your debt ratios and be like, okay, it would be beneficial. But I can tell you, 9 times out of 10, I am paying off people's debt with their down payment just so they can afford more of a house, rather than including it in the down payment. Because they'll come to me and they'll have $10,000 on a $10,000 car loan and $50,000 for a down payment. Well, we're going to take $10,000 off your down payment to pay off the car loan, and now you can qualify for an extra $50,000.
Right.
So even though we're reducing your down payment, you're qualifying for more since we're reducing your debt load.
What's the stress test look like right now? Is it 2% above?
Right now, the stress test is 5.25.
Oh,
interest
okay.
Rate, no matter what you're doing, if you're buying a house from an A lender, you have to qualify at an interest rate of 5.25. Once interest rates get above 3.5%, we're going to see that qualification change to the interest rate plus 2%, depending on what the government does. Right now, we're sitting at around like 2.5, depending on your situation. We can get you lower or higher, but it's very dependent. If you want to go with an average, I'd say 2.5. But the stress test also only really matters if you want the best rate and if you're doing a less than 20 years down. Or 20% down. If you're going more than 20% down, you have way more options when it comes to lending and how much of a mortgage you can get.
Okay. Yeah. What about the people in your industry? Like, I know, like, because of COVID, I've been pretty much shut down. So, like, in real estate, it's a people business. It's a relationship business. Mortgage agencies is much the same. It's, we want to be with the people. We want to help the people. Absolutely. We want to meet everybody, and it's just been the most inopportune time to try to scale your business. So, do you physically actually meet clients? Like, has it happened?
It's happened. but it is a rarity when it happens. I love meeting my clients. I love all of my clients. They're all great people.
Right.
However, with this pandemic, we weren't able to. And so a lot of lenders have switched over to e-signature. And to be honest, you can do a lot more work at home than I can going place to place. So I can send out 15 compliance documents to people saying, hey, I got you a mortgage, by the time I would drive to one person's house.
Right. So a little more efficient running of the business.
It's become more efficient, but it's become less personal. And in my business,
less scalable in terms of growing your business, because you don't make relationships or friendships or lifelong clients over DocuSign or an email.
Yeah. Well, it's become easier, but then it's become less personal as well. And I really like to get to know my clients. I really like to know what details are going on. Like, what kind of a mortgage should we get for you? Do we want to get a mortgage where you have more of a prepayment option so you can put more money out of your income down on it? Are we looking for a mortgage where it's like, okay, maybe we're going to have some fluctuations in our income, or maybe you want to buy a house in 3 years, so we can factor that into your mortgage to make it as cheap as possible for you and you can save as much money as possible.
Right.
So getting to know my clients, it's been terrible for that, but I want to get to know my clients. So pretty much it's taken away the personability part, but it's increased the efficiency of it.
Yeah, that makes sense. I don't know, and I know you're a huge people person. I am too. I'm in an industry where I still get to meet people, which is lucky. Like, they just this past, I just got notified we're allowed to do physical open houses in Ontario again. So, thank God for that, because, that's where I meet a lot of people. And if people are just kind of like casually looking, they're not represented, they're coming into a home, and then all of a sudden I'm starting that dialogue and starting, getting to a point where I might be able to offer these guys service, right?
No, absolutely.
So at least things are kind of going that way, but I'm just trying to imagine myself in your position and how, how do you connect to people when really, you're in the financials, which at least I can offer a house. A house is people can see that, right? People love money, but they also, for the most part, unless you have that business kind of mentality, most people hate debt.
No, absolutely.
So there's that kind of dichotomy, right?
Yeah. Well, see, debt gets a bad rap, especially during very low interest rates right now. So, for example, during the lows of the interest rates, when we could get you an interest rate of 1.89 fixed for 5 years, you could get a mortgage, pull out as much debt as you want, invest or refinance. Your rate is 1.89. That's the percentage you're paying on your debt. You can take that same money, invest in, let's say, TD Bank, who was at the time paying 4% dividend. So you could take your debt, put it into a stock, and they're going to pay you more than you're paying on the debt.
It is an opportunity of a lifetime, especially when we had that COVID market correction pullback.
Yeah.
I mean, there were definitely huge opportunities out there. Now, the market's a little bit different now, but
it's getting to be a closer gap. So let's say you can get an interest rate of 2.5, you can find an extremely safe investment that's going to pay you 3 or 4%. So the option's still there. And the other thing is, it depends on what kind of a lifestyle you want. If you want to renovate your kitchen and you don't want to pay $50,000 cash, refinance your mortgage, put that $50,000 debt into your mortgage, and now you're paying it out over 30 years, and your payment's only gone up about $50 a month.
You barely notice it, and then, of course, you're building in that equity. You've invested in your home, you get to enjoy that beautiful kitchen. Absolutely. Your home's worth, $50,000 more.
Yeah.
So, there's huge benefits to that. What about... Do you guys, because I know we just had a meeting yesterday about FinTrack compliance, and if anybody doesn't know, FinTrack is just basically they're the authority on financial, tracking to make sure that, when you're dealing with somebody, they're not laundering money, they're not, funding terrorism, they're not trying to run money through our system and just try to, screw everyday hardworking Canadians. And we touched on crypto. Do you guys talk about that at all with in terms of like financing or?
Right now, if you have cryptocurrency and you want to buy a house, sell the cryptocurrency and put it into your bank account, because nobody wants to look at it as a source of down payment. So as long as it's been in your account for 90 days, we're happy. But if you've got cryptocurrency,
Like if you got crypto in your wallet,
yeah,
and so say that's been in for over 90 days,
yeah,
and I mean they do track what that's worth in the markets now.
absolutely.
So does the bank credit you for that time that you've actually held it in the wallet?
No, and they don't even count it towards anything. Like you come to me with $100,000 worth of Bitcoin, and I'm going to say, you're doing fantastic. That's great. You've made tons of money in Bitcoin. I'm proud of you. If you want to buy a house, it needs to be in a bank account for 90 days.
The lawyer who was a part of our meeting there yesterday, he was very, adamant that, and it almost made me feel like, because I was kind of bullish on crypto for a while, but just the fact that, and this guy, he's big on the compliance end of things, and he just said, like, we don't deal in it.
Yeah.
And I just thought that was interesting because, there are sellers out there who will sell their house with it.
Absolutely.
So does this raise like a big red flag, or like a almost like a separate segment of the housing market that might be private deals through crypto, and does that also open up doors for laundering and crime and funding of terrorism?
Well, I can't speak to the crime portion of it, but what I can speak to is the volatility of crypto makes it unreliable. Purchasing a house can take between 30 and 60 days. And if I say my down payment is going to be 3 crypto coins or Bitcoins, well, at one point they were worth 50,000. By the time it closes, they could be worth 30, which means that
Right.
the person who's selling their house is losing out on $60,000. Now, whether or not they would have to contribute more Bitcoins or less, you made an agreement for 3 coins. So I think that's where we're going to see a large part of the reason why we're not seeing it in the market is the volatility of the coin and how long these transactions take to take hold.
Yeah, I mean, I do see a lot faster turnover than I ever have, but you are right. Like, just like the day-to-day trading volatility is something to consider.
Yeah. Well, if we look at Bitcoin over a month, even we've had months where it was at 50,000, dropped down to 25, and we've also had months where it was at 25 and gone up to 50. If you're buying a property and putting 3 Bitcoins down, are you willing to pay or double that price because your Bitcoins doubled in value?
Mm-hmm. Hey, listen, I'm just thinking on another track here. I did meet this guy. He's a pretty great guy, really motivated, super. He's a go-getter, and he's really trying to grow his like flipping homes business.
Yeah.
But he would only be able to qualify privately for money on those. What do you think the best avenues for him to pursue are, just to kind of fund these quick turnaround projects? And they're kind of seasonal too. So how would that? What do you think the best option is?
There are a large amount of investors that use a holdco to purchase properties with, because then you're looking at a majority of the down payment and you're looking at it more of his business side or business effect. But we're also seeing in this market that if you're buying a house, in 6 months you could turn around and sell it and be up money. So if you're flipping houses, even if you're using private money, in 6 months you're usually ahead of the game. And we've had clients where they've purchased a house with the intention of selling it in 6 months and doing some light renovations, and they've come out of it $50,000 to $100,000 plus, depending on where the market was.
So, can you tell me a little bit more about private money, like just like in terms of like, fees, rate difference, and then actually what do you need to qualify? Like how is it,
Well, whenever we're talking about lending outside of the major space, you need at least 20% down.
Okay.
That's the first hurdle you have to cross. Secondly, interest rates are vastly different. A good interest rate in the private area right now is 5.99.
That's really good. I'm surprised it's that
that is
low.
pretty good. But you're also looking at a 1 to 2% lender fee on top of all the money they're giving you. So your effective interest rate is closer to 7.99 or even 8. depending on what you're buying and where you're buying.
Right. So especially if you're like doing like a quick flip, like 3-month flip,
Yeah.
and you're paying that fee up front, well, then all of a sudden that money got a lot more expensive over a short amount of time.
But with private lending, there are a lot more options. For example, if you wanted to have a lower interest rate or a lower payment, you can actually pay more upfront. So instead of having a 5.99% interest rate and a 2% lender fee, you can pay 5% lender fee and have a 2.99 interest rate. And some lenders some lenders just in general, privately, will give you the money for all of your monthly payments throughout a year if you pay them an excess amount of money or you accept a higher interest rate on that money. So like there's a lender out there that will, let's say you borrowed $500,000 from them, your payments are going to be $3,000 a month. They'll say, we'll give you the money to make all of your payments, but instead of us giving you 5.99, we're going to give you 8% interest rate. And it's all going to be due at the end of the year.
Right.
Yeah. So privately, you have a lot of options, but you are going to get a higher interest rate and you're going to have to pay a lot more upfront.
Yeah, that makes complete sense. So what do you think, like, for a guy who's trying to scale a business like that, like a flip business, and, you know, do you just keep going that private channel until you build enough, you know, capital to actually fund your own cash buys, or?
It's a huge question on how you want to do it. Because if you own a house and you want to rent out your house while you move into another one and start renovating it to sell that property or to turn it into a rental, you have a huge amount of options. I did one earlier in the year where he was a close friend of mine and he owned a property. He wanted to buy a second property, but he didn't know if he wanted to rent it or not. And I showed him that even on his own, just the rental market right now is so hot that it will cover your monthly payments and all your expenses, and we can accept that, and you can buy another house. Now, he did have 20% down, but what we'll see in a lot of as well is somebody owns a house, the equity's gone up massively, the house is doubled in value, they're refinancing, pulling out 25% and purchasing another property, moving into a second property, and the first property is now a rental.
And you know, it's not like I'm allergic to making money, but there have been times in my career where, you know, you've got clients and you're trying to look out for them, and you know, I understand, like, you want to move up, you want to climb that property ladder and everything like that, but you are qualified, you know, to do more, and that might mean taking on a bit more debt, and that might be a little bit scary, and you know, there's things to consider when you do take on debt. But at the same time, if you look at what you paid for this thing,
oh, absolutely,
you will never be able to replace the revenue generation of what it can bring you today.
Oh, yeah.
If you forfeit it today. Like you know, in 5 years, you'll be so happy that these people have been paying your mortgage.
Absolutely.
And you've still got, you know, everything you want. You've got the home that you want, but you know, obviously the debt load. I think Canadians are a little bit conservative about debt. I think it's starting to change a lot.
Yeah.
I think we're at the highest debt load we've ever been at, probably historically. So things are changing, but it's still a concern. You know, it's still I still think a lot of people still play it pretty safe. They want the security. They want to know that, you know, we're just kind of like, you know, we're focused. It's one road, one way down the road, you know? And they don't need that extra, but
a lot of people have that, especially from the older generations, talking to their kids about it. We can take a break, buddy.
I'm just gonna grab a beer. Keep it rolling. We can just edit it. Going?
No, I'm good. I'm still going.
Yeah, I mean, it's a good conservative way of living. You have all that peace of mind knowing that everything's gonna be okay. You haven't bitten off more than you can chew.
Yeah.
But at the same time, I think because you're comfortable, you don't get hungry. So you never try for more. Now,
well,
that's an attitude thing. That's a thing that I'm kind of like, you know, I'm hungry and I always want to grow and innovate and better and all those things. But, you know, I guess I get both sides, and I don't know if there's a right way or a wrong way.
Well, we can see the shift moving more towards the investor side. over the pandemic, 20% of the people who bought a house were investors. And by the definition of investors, they already owned multiple properties. Now, 20% buying up, well, 20% buyers in the market is huge, but those being investors, I think that's a real sign of change where people are expanding their knowledge base, learning what they can do with their wealth, and choosing to buy multiple properties.
You almost wonder if there's only so much room for so many people to get wealthy, because here you have, this middle class investor class that, which are way behind the real estate investors of yesteryear who there were some people who, really hard and fast, acquired and disposed assets and made money in bigger and bigger projects, right? Now we've got this like middle class investor class, which is essentially putting such a pinch on the real estate market that here we have our children who can't even think about owning a home because we've pinched them out of it.
Absolutely. I think the best way for first-time home buyers to start getting in the market is for us to produce hundreds of thousands of new homes. Expand the amount of available properties. Because if we stay stagnant and not growing as quickly as we would like to, well, we've already filled every home.
And that's the other thing too. Like I know that there was talk about like taxing over. I want to say a $1 million like luxury tax. Might have been a little bit higher than $1 million. I'm not exactly sure, but this is nearing the average home price now.
Yeah.
So who are you really taxing is the middle class who can't afford to pay more tax.
Absolutely. So
it's not going to curb anything. All it's going to really do is just punish people.
Yeah. Well, I was reading an article from Bloomberg earlier today where they pointed out 18 months ago the average home price in Canada was $589,000. Mm-hmm. The average home price today is $752,000.
It's pretty much where we're at in the London market right now.
But that's a 50% increase over 18 months. That is massive, and wages have not increased by 50%. Not even close.
I'm bullish on housing, and maybe it's because it's the industry I'm in, and I see it. And I saw like the hottest December, that we just had was like one of the hottest months of 2021. Coming into January, and even as an expert, you go into houses that are being multiple bids on a house. Normally, you have a pretty good formula. I've got a pretty good system of trying to this is what's gonna this is the number Absolutely. That's gonna buy this house.
Yeah.
And, you kind of get your shell shocked when you start to figure out, holy cow, I'm off by $70,000 to $100,000. Yeah. How is that?
Absolutely.
I look at London. I look at London and I compare it to, like, for example, the KW region. Their average home prices, just for the first time in history, hit over $1 million. And I think to myself, I'm bullish on London. Like London, it's a major city. Talking, industry investment, Maple Leafs coming, Go Transit, things that are going to kind of link
it to
the east, to the GTA, to and just the fact that office space doesn't even need to exist really because people can work from home, so people can commute to Toronto for that one day a week where you need to go to an important meeting or an event. So people are understanding the value in London, and we're still, average house price $250,000 less than KW. We have all the amenities of a major city, traffic routes, sports teams, arenas, concerts. We've got everything that you could possibly want, and that's my reason. I think, people are talking about pullbacks and plateaus. I don't see it for London, and that's just my own personal viewpoint. Like we had Phil Soper, who's CEO of Royal LePage, talking about growth. It sounded what he was talking about was healthy growth, and perhaps maybe a bit of a plateau in 2022. But in my region, I just cannot see it. I just think we're just amping up.
Well, I can't see any reason for the market to go down either, and I'm bullish on the market as well. I'm seeing a lot of people who worked in Toronto moving over to Windsor and buying properties there because they're super cheap. And that's part of them wanting to grow their own wealth, and they couldn't afford a place in the GTA, so they're just moving further out till they can buy a property. When it comes to the London market in general, I'm definitely bullish on it, because I really can't state enough that I can't see a reason for it to start to go down.
I even look at like fringe cities like St. Thomas, which the notorious 25% more life in St. Thomas.
Yeah.
It was on the radio all the time when I was growing up, and I'm looking at the market trends. We're less than 5% behind London in terms of like housing prices, and I'm just thinking, well, St. Thomas is a great city, and it's got a lot to offer for a lot of people, but I almost feel like, not that St. Thomas is overpriced, but that just London is underpriced.
Yeah.
And I feel like investors are going to see that, and they're just going to be, I feel this year is going to be a huge, huge year for London.
No, I can definitely agree to that.
So when can I sign you up for another house?
Well, I'm quite happy in the house I'm in right now.
Couple renos you had undergo. Did you finally finish that bathroom? Or?
Yeah. Well, it's on the go. It's at the point where it's 99% done, and the tools I need to finish are being used by someone else right now. So I'm kind of just like, okay, once your project's done, I just have some framework to do, or some woodwork to do, and just a little bit of tiling, and we're done.
Nice, man. Mm-hmm. Yeah, I mean, it's one of those things. You either have time or you have money, but you never have both.
Oh, absolutely.
And in real estate, I know like a lot of people probably think, because real estate's hot, and they don't think about, well, the money side of it. Because I think a lot of people, their perception is, these guys are getting paid.
Yeah.
And I think one of the things that's important to kind of, just kind of put to air is the fact that when there are 18 offers on a property, there's 18 people who've done all the work, all the same amount of work, but out of those 18, only one get paid, right? So,
absolutely.
It's the one with the sign on the lawn that gets paid, and it's the other, 17 who go home and say, well, we'll try again tomorrow. So, as much as it's been a hot housing market, I got to congratulate, and, I'm very proud of my colleagues in this industry for the persistence and their diligence and their follow-ups with clients. Absolutely. And just the professionalism that they show during a pandemic. And not only that, but like an increasingly competitive market that, for no other reason, you just may not be the one to get paid on any given day. And you've got to, adapt quickly.
Yeah.
And it's almost like, we get market stats, and we get data, right? But it's lag data. It's always a month old.
Absolutely.
So if you're not a professional who's forecasting, and you're not thinking, where's it going? You gotta, it's like Wayne Gretzky, right? Like, where's the puck gonna go?
Yeah.
That's what he always said. Where's the puck gonna go? That's where I'm gonna be.
Absolutely.
You don't have to be the fastest. You just got to know where it's happening and where it's gonna go.
Yeah.
So for certain, London, Ontario this year, and pricing, you're gonna have to call me if you want to know what I think about where things are going.
Yeah, absolutely. A lot of people thinking that the rising interest rates will
snuff it out.
However, those people usually aren't in the mortgage business or the real estate business.
I almost feel like too, there's like a bottom, percentage of people. Like there's got to be like most. Well, how does it stack up? These debt ratios are. I know there's a certain standard. What is it? 32% total debt.
No, it is 39% gross debt ratio.
Okay.
Which gross debt ratio is your cost of the house, cost of the property tax. By cost of the house, I mean your mortgage, property tax, and your heating. When it comes to your overall debt ratio, which is a max of 44%, then you're looking into how much of your car payment it is, how much of your credit card payments, line of credit, anything where if you stop paying it, someone's going to come after a large amount. So, for example, Your co, that counts against your ratios. Your co-insurance doesn't, because if you
So your cell phone bill wouldn't, but like
Yeah.
an asset that you own that you're still paying against.
Exactly.
Got it.
Yeah.
So, okay. So 39%
39 and 44.
and 44.
Now that is
Now-
if you're going into the major lendings. If you're going 20% down in extras, you can go up to 50-50, 60-60. Depends on what you're doing. But if you have less than 20% down, you're stuck with the 39-44. Doesn't matter who you go to.
Okay. So are you seeing things trending up? Like people are getting tighter and tighter to those, limits, or like, cause that's how I would predict it. Like people are, they're spending more, have raises kept up with inflation? Don't think so. I don't see people making more money. Everybody's still dreaming about a 6-figure salary, but instead they got 6-figure bread prices and egg prices and milk prices, and
Absolutely.
So unfortunately, it kind of went the wrong way. Gas prices was like $100.50 a liter.
Yeah, $1.50 I think. On average.
Crazy. So
Yeah, it's been completely crazy the past few years. But what I've seen historically in my own experience is it doesn't matter. It doesn't matter how much you're making. They're always going to the maximum. They always want to buy the maximum amount they can with their debt. So
in my opinion, that's smart.
Well, you're buying more, which means that you'll get more appreciation, which means your equity will grow more.
If you're thinking, yeah, exactly. If you're thinking of it as an investment, your home's an investment, and it's laddering, and you get, X amount of appreciation. I think it was like 34% in London last year.
Yeah.
34%. If it was a townhome, it was closer to 50%. Or sorry, semi-detached, it was like closer to 50%. So, if you're really thinking as an investor, you're like, okay, I'm going to buy the maximum that I can buy, but I'm going to buy a semi-detached because I know it's out of all the housing segment, it's the fastest growing segment.
Yep.
Is that really like the lay home buyer's mentality, or is this just coincidental, or is it just like, inventory, or the fact that, those kind of homes are just a little bit more, by nature affordable, so then they've had more growth because more people are putting that pressure there?
Well, throughout the entire market, we've seen a rapid amount of growth. And if you're buying a house, you got to remember someone's selling a house. So it is unusual for someone to sell a house and not move into another house. So as long as you've got movement on the bottom end, you're going to have movement on the top end as well.
Is that going to be true into the future? Because like you mentioned, more and more investors are kind of piling in. Like you said, this influx of investors. Obviously, they don't need to live there. Mm-hmm. Is the end game for these people to capitalize on a few quick years of appreciation and then sell the home? Or is it like a 30-year game plan? These guys are going to pay my mortgage. Like,
the majority of investors that I've dealt with, they're looking for rental properties. That's their main focus. That's what they're trying to build. Massive amount of rental properties. And when they retire, they'll sell their portfolio to another investor.
So is that what you're seeing? Just more like, hey, we're going to buy more and more properties. We're going to leverage off each property to acquire more. And that's just the game. We're just going to keep on buying and buying.
Yeah. That is the majority of investors I've dealt with.
I feel really bad for the first timers.
Well, you got to look at market rents. Like you can get a mortgage on a property. Let's say it's a $300,000 home. You can get a mortgage on that for $11,000 a month. But the rent in London right now is $2,300, $2,500. So once you have the mortgage, the rent is more than double your mortgage payments. So that's why all these investors are piling in. And that's not even including how much money they're making in their equity.
Do you ever do any coaching? Because I understand that, and I see it all the time on social media. I see people. They're always saying for the price of the rent, I could buy the place, but they can't.
Yeah.
Because they don't have the capital to put down.
Yeah. They either don't have the down payment, or they don't make enough money to qualify for those higher payments.
Right. So so there's that, the landlord standard of the tenant they want to qualify.
Yeah.
And then 2, just not having the down payment. So
Absolutely.
is it a landlord's game, or is it the game that they're going to try to keep everybody, as poor but able to pay as possible?
I always see it as an individual basis. No individual wants somebody to not get into a house. But what they do want is for themselves to make money. So no one's trying to keep first-time home buyers down, but at the same time, nobody wants to be outside the real estate market while it's having these massive booms. So investors, they're sitting there like, I have 3 properties. How am I affecting the market at general if I buy another one? So, but if you get 10,000 of those people all together, all bidding on these properties, you're going to see massive booms in the amount of them, which also increases because once, like I discussed earlier, once one house price goes up, all the other house prices around it are now valued at more.
I look at the same thing, just like how my life's changed in the last year, a divorce and just changing lanes and things are going different.
Yeah.
And buying this building, and I looked at it kind of, retrospectively, and I'm thinking to myself, oh my God, you're so lucky you bought that place, because if you didn't, you'd actually I would have been crippled financially, personally, just by not having the place.
Yeah.
Because, when you're talking about appreciation, 30%, well, all of a sudden my down payment is worth so much less.
Oh, absolutely.
So I was so thankful, that one good thing happened out of it, that I, was able to, rebuy and for a decent price and have a property worth, value that's appreciating.
Yeah.
So I think, and I know this has happened to so many of my friends. So many of my friends have got divorces since COVID, and I've had 3 calls in the last 4 weeks about people saying, I'm going to get, we're getting divorced. I'm sorry, it's just, this has gone on too long. I feel like, I'm in a prison where my life's at, and I don't have any freedom, and I can't do this, and we don't see eye to eye anymore, and I don't have my friends, and I don't have, just, you're kind of you're just alienated from society. Absolutely. And all you have is your person. But over time, the grind, you just grind on each other so long, and this is kind of just something that happens. But I guess that what my point is this is a thing, and people are counting on, hey, you know what? It sucks. I'm divorced. It's temporary. Let's kind of wait it out. Yeah. Let's see if there's a bubble that's going to pop. Let's see if, situation's going to change. Don't.
Get into
pull the trigger. You'll never regret it. I mean, if it's a divorce that, you think maybe there's a separation, you think there's a chance you could work it out.
Oh, absolutely.
Buy a place. It could be your rental property in the future if things worked out with your ex.
Yeah.
If things are going the other way, and you find somebody new, or you just want to be by yourself, at least you're in that market that's appreciating, it's creating wealth, it's giving you leverage to borrow, which if you want that boat, or you want that toy, or you want that quad, or a new car, and you want to finance it at a better rate, you have that opportunity. But don't sell yourself short by just waiting.
No,
because
absolutely.
when you wait, you're behind.
Well, a lot of people, with my best friend, me and him were ready to buy a house at the same time. Now, I had $30,000 as a down payment. He had $70,000. But he wanted to buy a house for $500,000, and he wanted to put 20% down. So he was $30,000 short. I was okay going in with my $30,000 and paying the mortgage insurance on top of that. So I got into the market January 2020. He decided to wait a year to save up more of a down payment. Now he made it to $100,000 in savings over a year. But the market had expanded so much in that time frame that his house that he wanted to buy for $500,000 was now valued at $650,000. So him staying out of the market cost him 50%.
Is this the guy's in Quebec now?
And he bought in Quebec now because of that.
He's got a curfew right now.
Yeah, well, it was the only place he could buy a property within his 20% down and what he wanted. And he could have had that 1 year earlier if he had simply bought into the market as soon as he was able to.
He could have, he would never had the opportunity to learn a second language.
He still doesn't.
He's just like a low functioning Quebecer at this point.
Absolutely.
English speaking. Is he bilingual or no?
No.
He just wanted a cheap house.
Nobody in his family is. He just wanted a cheap. Now, that being said, he bought a 10-bedroom house in Quebec for $394,000.
Which, I mean, it sounds impressive, but I don't even think that their rental, market is strong there either. Like,
he's not going to see the same kind of appreciation that anyone in Ontario.
And I don't think you're going to find people who need a room to rent either.
Not as much. I don't know the exact details of the rental market up there, but
I think if you got 100 rooms to rent, nobody opens the door. You're kind of
Well, actually, his 10 bedrooms is only for him and his kids because he wants to have full children and work rooms and all that stuff.
Mm-hmm. We're gonna miss him. One thing that is important for me in my business is community. Obviously, growing community. I'm new to Port Stanley. I've only been here a couple years, but I did join Kiwanis, and I'm pretty proud of Kiwanis. I'm proud because we're a new club, and we're just trying to make our name for ourselves. So I'm representing. I've got my Kiwanis shirt on here today, and one of the things that we're doing is recruiting new members for any people, any all ages, whoever you are. Come, please join Kiwanis because we need the membership in Port Stanley.
Yeah. And
we want to start doing bigger events, bigger community involved events, so more hands would make it a much easier thing. So our one project we got, it's just kind of a light project, but we're going to sell for Valentine's roses. So, if anybody, Port Stanley, or, you want to support Kiwanis, or you just want to make that loved one feel special, buy a rose, support Kiwanis, give back to kids. Yeah. And we've got big things coming with Kiwanis because we've got big community goals. We're working on some things on the back end right now, but there's going to be some big announcements of where we're heading with Kiwanis, what we're trying to do for Port Stanley, and we've got goals, we've got targets now, and I think you're going to see a lot more of Kiwanis in Port Stanley. So come on out, make some friends, and of course, buy a rose and support children in the community. And that's what I wanted to say. You should join Kiwanis. What are you doing? You're not a Kiwanian. You don't have a shirt.
Well, I don't.
You don't have a shirt like this. You don't have this.
Well, I don't live in Port Stanley.
Tell me
about Kiwanis.
We have
what does the group do?
We have other members that are in St. Thomas, and they come. So it's only we only have to meet once a month. I'm on the board of directors, so I got a little bit more responsibilities. I'm the treasurer. But yeah, essentially what you would do is we fundraise. We're talking about a big project for the town. We've had some of our members reach out to municipal political figures and kind of just get started on where and what we can be of service with and what we can be in cooperative effort for. And we've got a couple great ideas and we're drumming it up right now. It's still kind of like low key. But there's big things coming from us, and it's for kids. It benefits kids in our community. And, for somebody like you, Nathaniel, I can't believe you're not a member.
Well, it sounds like a good opportunity, and I would definitely keep it under consideration. International, eh?
Right now, they've got they're paying half your dues, so you only pay, I want to say $100 for I think they cover $100. Maybe it's only $60 for the whole year.
Okay.
It's the best time to sign up.
Yeah.
There's a special promotion going on for your dues. So Kiwanis International is covering a portion. If you are interested, just reach out, text me, call me. I can give you the details. We need more members. We need more help. We need more support. We want to hold bigger events and raise more money for all the kids in the community.
Yeah. And if you can't get a hold of Ryan, contact me. I'll get you two in touch.
Okay.
I'm just saying, if you can't find him, I'll get it done.
Okay. My phone number's everywhere.
I'm just saying, some people know me. Anyway, we should probably wrap it up. It's been Absolutely.
our first time, so congratulations on our first podcast ever. New to it. I'll put it on Spotify.
I'll put it on YouTube.
And I'll put some snippets out there so I'm not boring the shit out of you people. But yeah, so thanks for coming. I think we should do it, more often. Maybe a monthly thing and just kind of discuss
that's what I was thinking.
As things evolve, and then that way it kind of gives us a chance to talk and better inform our clients about what's the current condition.
Yeah, absolutely.
Okay, Nathaniel. Well, thanks for coming.
Thanks for having me.
Appreciate it. That's a good handshake from a guy with red hair. Anyways, thank you all for joining and thanks for listening if you've listened to this podcast. And we appreciate all your support. And if you have any questions about buying, selling, or financing a home, you know how to get a hold of us.
Absolutely.
All right. We'll talk to you soon.
Thanks for coming, guys.
Okay, thank you. Bye.
Bye.